Next up, in a couple of minutes, we're going to have a session on tax policy reform, primarily centered around the implications of cryptocurrency. I'm sure that's everybody's favorite topic. It certainly is an interesting topic. I don't know about you guys, but I have a very hard time really understanding the nitty-gritty. But we have an unbelievably great panel for all of you today to walk through it, get a little baseline and some fundamentals around what is cryptocurrency, blockchain, how does it work, why is it meaningful to us, and then obviously, how a regulator is going to be dealing with that going forward. So as part of this discussion, I'm happy to tell you my partner, Eric Coombs, is going to moderate this discussion. This is probably one of Eric's favorite topics, so you are in very, very good hands, and you have an excellent panel here to talk through the really cool topic of cryptocurrency. So with that, Eric, I'm going to turn to you and enjoy the discussion.
Great, thank you, Mark. Appreciate the introduction, and good afternoon, everybody. For those of you on the East Coast, I know we've got some West Coasters, so good morning to you as well. Thanks for joining our discussion today. Really excited to chat about cryptocurrencies, or digital assets, as I like to refer to them as. We've got a really great panel lined up for you today. So I'll just briefly, I'm Eric Coombs. I'm a tax partner in our Grant Thornton's South Florida practice, and I lead our national asset management practice from a tax perspective as well. So with that, I'll give each of my co-presenters an opportunity to give a brief introduction. So take it away, gang. Jump in as you see fit.
I guess I'll begin. My name is Mitch Hyman. I'm an assistant United States attorney here in Miami, and I'm in the asset forfeiture division. Before I start, or before I go any further, although I work for the U.S. Attorney's Office here in Miami, I'm not representing the office or the Department of Justice whatsoever. Anything I say today is strictly my opinion and not that of the federal government, and should also not be taken as legal advice. So I just had to get that disclosure out of the way before we start.
Hi, everyone. I'm Chris Katarba. I'm a managing director at Alvarez & Marsal based in San Jose. I specialize in international and crypto tax, and look forward to talking with the panel today.
Good afternoon or good morning, everybody. My name is Yara Jatin. I'm a tax principal at Kaufman Rawson. I lead our corporate tax consulting and M&A practice. I work very closely with the companies in the technology industry and in the cryptocurrency space, and I'm very glad to be with you here today. Thank you, Alex.
Great. Well, thanks for those introductions. So I'm just going to lay out sort of a brief outline of what we're going to be covering over the next hour and change. We thought it would be important to lay out a foundation of general crypto knowledge before we dive into the deep tax implications of the various transactions that are possible in the digital asset space. We'll then jump, so we'll go from sort of general discussion to more in-depth tax discussion, and then certainly focus a bit on tax reform and what might be coming down the pipeline here. And then if time permits, we will get into some regulatory topics. Obviously, we've got a great resource here with Mitch, so curious to hear his views in that regard. And then certainly touch upon sustainability, which I know is one of the, or is the theme for today's presentation. So with that, I'll kick it off with a very general question for the group. I get a lot of friends, increasingly more that come up to me and say, "Hey, Eric, I know you dabble in the digital asset space, and I know you serve some clients in the space as well." And the question is always, "Hey, teach me about crypto. Can you explain crypto or digital assets to me?" So, let's maybe kick it off with Mitch. When you get that question, how do you describe digital assets in the crypto space to somebody who is entirely unfamiliar with it?
So I feel like at its simplest form, it's really an easy concept. It's just some type of content. So digital asset is just some type of content that's stored electronically. It could be anything from a digital message to text, like a PDF that we're used to seeing, audio file, whatever the case is. When we're talking about virtual currency and cryptocurrency, we're talking about a digitized store of value. And that's really like what it, like at its simplest form really is. I feel like that's a good way to explain it for somebody that really doesn't fully understand it. So if you just think of it like that, so we all have probably heard of Bitcoin by now. But another way to think of it is if any of you all have children that play online video games and play Fortnite, they have what's called V-Bucks, and it's a virtual currency that you can only use in the game to purchase whatever in-game content you want on there. So it's really just a store of value that is digitized and electronic.
Great, thanks, Mitch. Chris or Yari, any explanation to laymen that you can?
I would just add that, you know, the appeal of it is that it is ideally supposed to be decentralized, right? So the purpose is to get rid of the intermediaries, get rid of the banks, get rid of the people that would take a transaction cost along the way of making various payments and storing value. What's interesting though is that as this evolves and gets more mature, you start seeing more and more intermediaries working their way into the system, exchanges, et cetera. So we may end up back where we started, but at least in theory, it's supposed to be more of a democratized way of storing value and also facilitating payments.
Great, thank you. So you touched upon decentralization. Yari, would you mind maybe just sharing some of the characteristics of digital assets that proponents of the space might point to as why, you know, these assets have value?
Definitely, and I think, I mean, Chris was on point. I mean, the appeal and one of the properties that are valuable about digital assets and cryptocurrencies in particular is that they're decentralized and they have an autonomous transaction execution by nature. These are assets that can be sent from user to user on a peer-to-peer network without need for intermediaries or a central regulatory authority. Another valuable property of digital assets is their transparency. Every blockchain user is assigned a public address. These public addresses are completely open, so anyone can view these holdings and transactions whenever they want, right? So how these assets also possess built-in mechanisms that provide, I mean, certain privacy to their users, or a lot of privacy, we would like to believe. So I would say that they're kind of pseudonymous, and on a blockchain, users can carry out transactions with one another without disclosing any information related to their identity. So at the end of the day, no one but the originator of the transaction, no one knows who the originator of the transaction is. And I would say that the two most important properties that make cryptocurrency valuable is the immutability and security that it offers. They're immutable, therefore secure, I would say. They have the ability, a blockchain ledger has the ability to remain unchanged. In other words, the blockchain cannot be altered, and when consensus is made, the originality of the data is maintained. So I would say that undoubtedly immutability is the ultimate feature of digital assets, of cryptocurrency in particular.
Great, thank you. So, you know, as many in the audience may be aware, there are, you know, something in the neighborhood of, I guess, depending how you count them, but, you know, last I saw, you know, 10,000 plus tokens that I think are readily traded on various exchanges. And of course, the liquidity in many of those is pretty non-existent. But the point is that there are a substantial number of tokens out there. But I think, you know, for somebody that's trying to understand the space, you can generally break them down into a few different categories to better understand which each of them is attempting to do. So Chris, would you mind walking us through maybe some of the different general categories of digital assets, and then with that we can start to talk a little bit about the tax treatment of various assets and transactions that they might be involved in.
Sure. So there's many different types of tokens. I think the most common would be a security token, which, like, the originators, Bitcoin and Ethereum, these are really investments. These are ways to store value. They may eventually have some, purpose in facilitating payments and transactions in the future. But really their main goal is to go to the moon, right? Increase in value. Another type of token would be a utility token. And this is really used on like an online platform to purchase goods and services. It's really supposed to be sort of an online type of currency, like Mitch had mentioned earlier. In reality, especially according to the SEC, there are very few utility tokens, and really most probably fall into the security category, but over time that may change. Another type of token is a stable coin. So stable coin it's really a type of crypto that's pegged to a currency like the US dollar, or a commodity like gold or oil. So if you ever see Tether or USDC, those are stable coins. Those are equal to one US dollar because they're basically a digital representation of currency. And this is becoming more popular as well. We're also starting to see governance tokens, which are interesting ways of allowing people to vote on blockchain projects, to determine how they want them to run. Maker is a popular governance token. If you recall, the DAO from a few years ago was a way for people to essentially make decisions using tokens, which is kind of an interesting, raises a lot of legal questions. And then finally, there's non-fungible tokens, which have become very popular recently. These are, as they say, they're not fungible. It's a unique piece of the blockchain that represents a digital piece of art, digital music. It's supposed to be unique, so that it's really the only identifying piece of this blockchain. So even though it can be copied, you actually do own the so-called original of these digital pieces of work. So definitely evolving area, very popular. You'll see a lot of NFTs going for millions of dollars, and we'll have to see where this goes.
Yeah, definitely pretty interesting, especially on the NFT side. I know there's a lot of debate about, why NFTs may or may not have value, and that we could probably spend the entire hour just debating that standalone question. So, sort of jumping into the tax treatment of digital assets and cryptocurrencies, right? So you just laid out, a handful of different categories of tokens that all can be used in a variety of ways to either pay for things, vote on, certain provisions with respect to, the direction of a blockchain project, stable coins, which are meant to sort of track the value of the US dollar. So Yari, maybe if you wouldn't mind starting kind of at just from a general, 50,000 foot overview, how generally speaking, is the digital asset space taxed? What are some of the general principles with respect to taxing and reporting, transactions in the digital asset space?
Thank you, Eric. So the reality is, as a lot of you already know, there's very little guidance from the IRS, even as of today. The tax treatment of cryptocurrencies has not yet been codified. However, we do have a notice from the IRS, which provides that cryptocurrency is basically treated as property for federal tax purposes. What that means is that the tax principles that apply to property transactions are applied also to exchanges of cryptocurrency. That also means that taxpayers that hold cryptocurrency could report gains or losses, right? When they exchange this cryptocurrency for property or exchange one cryptocurrency for another. Now, the type of gain depends on the holding period. So that's a general idea of how they're taxed. Now, it depends how you obtain the cryptocurrency, what the original nature of that income is going to be for tax purposes. And I mean, we're going to talk about mining, staking, and other types of other ways of obtaining cryptocurrency that have their own tax results.
Right. So generally speaking, I think everybody would generally be familiar with the principles that you're describing, right? You buy an asset for a given price. Let's say it's $100. That asset either appreciates or depreciates in value, and then at some point in time, you report a gain or loss based on the difference between those two figures, right? And I think equating that to sort of the way that any other asset that we're familiar with, maybe it's stocks, right? If that's the easiest way to, or easiest comparison, right? So that seems fairly straightforward. So that would be a crypto to fiat swap, right? So somebody comes in, they put $100 into Coinbase. That $100 goes to buying some Bitcoin. Bitcoin goes up or down, and then they swap the Bitcoin back for US dollars, and then there's a gain or loss. So that's pretty straightforward. Many may be aware now that there's the ability to swap directly one crypto token for another type of token, right? So Chris, maybe if does the same principle apply? And if so, what, you start thinking about the ramifications of how that might be taxed. It gets a little bit more complicated. So maybe you could walk us through that.
Sure. Yeah. So if you have one token of crypto, for example, Bitcoin, and you swap it for another token, Ethereum, that is going to be a taxable event. You're going to have to recognize gain or loss based upon the value that you're receiving minus your basis in the token that you're giving up. And that's probably not controversial. It's sort of like an old-fashioned barter transaction where you give up a cow for a house or something. So I don't think anybody disputes that. Where it gets interesting is that if you use crypto to buy goods or services, that's also going to be taxable, which is counterintuitive, because you would think if you used cash, you're buying, you don't have to pay any tax, but you do have to recognize the gain and loss in the crypto that you're giving up for the goods or services, which a lot of people may not realize. And the final thing to mention is that there are token swaps where you can literally give up the same token for a newer token that's maybe more updated on a different chain, and the old token becomes obsolete. There's really not a lot of guidance from the IRS on this. I think we're taking the position that you're really just receiving an update of the previous token you had, and that shouldn't be taxable, but it's certainly up for debate.
Great, thank you. So those of you that are familiar with the way Bitcoin works, and we described it a little bit earlier at the top of this discussion, I think many are familiar with the process of mining. So Mitch, maybe you could sort of walk us through that and what the tax implications of somebody that's performing mining activities might have to report.
Sure. So I think mining and staking, especially when it comes to tax, are probably two separate distinctions. The first one, mining, the IRS has already addressed in the IRS Notice 2014-21, I think. They talk about mining and those types of activities. And so without getting into like the minute details of cryptocurrency mining, the short version is that Bitcoin, for example, Bitcoin transactions are confirmed by people in their computers completing complex math algorithms to ensure that these transactions are accurate. And once it's completed, it gets added to this blockchain, like a block in the blockchain. And so as a reward for completing that transaction, they typically will get a transaction fee. And then once the block in the blockchain is completed, this is the mining portion of it, is it creates it mines a new Bitcoin. So a new Bitcoin is now into circulation. And so what the IRS says when it comes to that in their guidance is that these mining activities, any reward from that is going to be considered ordinary income. And so you would report it in your regular income taxes, and it's going to be taxed as such. That said, it's still twofold. So to hit on Chris's point, where if I'm a miner and I receive it, I'm going to have a day of receipt value. So I'll have let's say I get a Bitcoin and it's $1,000 at the time, which is obviously very low for what it is now. But just for math purposes, $1,000 on day one that I get it, I have to report that as income. And then if I decide to keep it, now my basis in that one Bitcoin is $1,000. So if I sell it 3 months from now and it goes up to $1,500, I've got a $500 realized gain that is also a taxable event when I transfer it. So the taxation on it is twofold. When it comes to mining, same thing with anything you're receiving, whether it's the Bitcoin as a result of its mining activity or the transaction fees, still going to be similar concept. Staking, however, hasn't been addressed by the IRS, and maybe some of the colleagues on the panel can talk to it more. But with staking, you are essentially providing, let's say, Ethereum. So I need to have 100 coins, 100 Ether coins to gain access to the mining network. And then I can now work for the network and receive. So I would imagine that it's probably taxed very similarly to the mining activity. So anything that you're receiving, I think is probably, as far as staking goes, is probably going to be taxable as regular income. So I don't know if anybody else wants to speak on that.
Yeah, can I jump in? A couple thoughts on staking. Like Mitch said, very, very new, no guidance yet from the IRS. There is a case though that came in Tennessee where a taxpayer is challenging the IRS on staking, and they're saying we should not be taxed when we receive the staking awards. We should only be taxed if and when we actually sell the coins that we get from staking. And their argument is kind of interesting. They're comparing stakers to like a baker, for example. A baker has an oven and has ingredients, and they're creating a cake, right? Well, they're not going to be taxed when the cake is made. They're going to be taxed when they actually sell the cake. And so they're saying, look, we're basically, with staking, we're creating new property. And new property shouldn't be taxed when it's created. It should be taxed if and when it's sold or exchanged, like any other property, including cakes. And so I think it's an interesting argument, and we'll see, how the judge comes out in the District of Tennessee. The other point I'll mention on staking is I do a lot of work cross-border, and we have some foreign clients that will be staking tokens in the US and getting staking rewards in exchange. And the question always comes up, do they owe US tax on these staking rewards, specifically withholding tax? And it's interesting because when you stake, you're basically giving your tokens to the pool, and they're using it to validate transactions and create new tokens. So it kind of feels like a lease kind of transaction, right? You're lending out your tokens, it's property, you're getting a return in exchange. And so that might be the type of reward that would be withholdable, like a rent or maybe a royalty. And so again, we have no guidance from the IRS, and that's certainly a bad outcome for taxpayers. But that sort of feels like the right answer.
Yeah.
Sorry, go ahead.
Oh, no, go ahead, Yari.
No, I would agree with that. I mean, on my end, we sort of see it as almost as an interest payment, right? Almost definitely ordinary income. You're letting them use an asset, your asset, and you're receiving something in return. And I mean, the points that Chris brought up are very interesting from the international perspective. So that's all I have to say about that.
Yeah, if I could jump in too, just to kind of bounce off of Chris's point, to play devil's advocate here, is there a difference between, a savings, like if I put cash into a savings account and I'm pooling my money towards the bank, right? And then they are doing what they will with it, and I'm taxed on the interest rates. So, could those mining rewards be considered interest? payments, like dividend payments or something like that, will it matter how much input I have into it? If I'm just staking the coins to give other people access to the mining network, am I really like mining these things? Maybe not necessarily. Should I be taxed as ordinary income, or, if I'm receiving it, should it be a dividend? I don't know if anybody has opinions on that. Maybe what we'll see coming up.
Any opinions there?
I see it closer to interest income than anything else.
Yeah.
It's definitely interesting, and I think just this fairly simple example illustrates the great deal of uncertainty that currently exists with respect to the taxation of this. I think, and we'll get into this now, I think, but regulators, I think, have been slow to react to the rapid pace of development in the digital asset space and the types of ways that folks that earn digital assets can already generate revenue for themselves. And so maybe with that, let's jump into, stepping back. The folks in the audience hear us talking about staking, and we're swapping tokens and creating tokens by staking. Let's step back a minute, right? Can you guys describe some of the sort of the real world use cases? And I say real world, right, because we're still operating in the digital asset space, but I think many of the platforms that have recently been created, let's call it in the last 5 years, and certainly more every day when you talk about decentralized finance and such, many of these platforms are starting to replicate functions that are currently being done in the real world, right? So Mitch, maybe if you could describe some of those, and maybe this will give a little bit more meat to, why do we care about how this stuff is taxed? So with that, Mitch, I'll turn it over to you to describe some of those platforms.
Yeah, sure. It sounds like Chris is much more knowledgeable on the staking aspect and the lending aspect. So I think, what I can cover is probably just in my opinion, is the greatest value add from the development of DeFi or decentralized finance platforms is just the fact that it's given people around the world cheap access to money transmission services. And it's provided generally a more secure way of funding or funds transmission to people that are considered underbanked. So, for example, in India, I think something crazy like 50% of the population has a bank account. The other 50% just, have cash lying around, which inherently is probably dangerous, right? And so now with a cheap form of communications, or a cheap form of communication being like cell phones, I think I read a statistic that said, while 50% are considered underbanked, like 75 or 80% of the population in India has a cell phone. So now they have access to cryptocurrency, and instead of using cash, I can now, exchange and not carry around cash, which is nice. And it's also cheaper. It takes the big banks and these big time players that generally charge huge fees to transfer money from one country to another. I can do it with a cryptocurrency and pay minimal fees, if any.
Yep. Yeah, definitely some great advantages there, particularly for the developing world, right? Chris or Yari, are either of you familiar with any of sort of the decentralized finance platforms and sort of the benefits that they generate, or perhaps some of the other forms of what I'll call real world use cases, such as gaming, or Mitch brought up NFTs previously. Any thoughts there? Or maybe if you could provide just some greater description of those types of transactions, and tying that back into sort of the conversation about what is it, interest, is it dividends, that along that line.
As far as decentralized finance, it's not only the alternative to banks, under the original nature of simply, performing transactions, but also the way we earn money. It's become more sophisticated with a lot more alternatives. One of the DeFi platforms, Yearn Finance, what they do, it's pretty amazing. And they have their own token, and they offer like sort of like savings accounts, and then they accept deposits, and they automate how you earn interest. They basically combine all their platforms, and through automated processes, they figure out how to get you the highest interest. So I think that's pretty cool. Curve Finance does something very similar. They also have decentralized governance. A lot of these platforms, once you own a token, you have the right to vote on how these platforms function. So I think that's a very cool feature of these decentralized finance platforms. Great.
Yeah, and just to talk about NFTs again, I mean, I do think this is a really interesting way for individual artists to get paid for the work that they do. It's been very hard for digital artists to really generate any money because anybody can copy a JPEG, right? And if you don't have to pay for it, then what's the value in it? So this is certainly good for artists. It's good for musicians as well, who historically have, excuse my language, gotten screwed by record labels. And this gives them an opportunity to, sell albums and online as NFTs and get paid for the work that they create, which I think is really a good thing. And so has a lot of promise for the future.
Yeah, to piggyback off of Chris and NFTs. So, I mean, the idea is that NFT, a non-fungible token, is that each digital piece of art, for example, it has its own unique serial number. And so if I transfer it from one person to another via the blockchain, that transaction is recorded. And so one thing I found interesting about NFTs in particular, now that people are starting to talk about it, is you can build into the smart contract as an artist. Every time ownership is transferred, everybody knows that I've got the copyright, but also everybody knows that I was the original owner or the original creator. And every time it's transferred, I can get a piece of that transfer and the money that is exchanged. I thought that was really interesting because if I'm a painter and I just sell, a painting, it's just like a one-time lump sum fee and that's it. And if they go on to transfer it, how do I know if it's transferred or not? I don't. So with, NFTs, they have that ability now, which I thought was pretty interesting.
I mean,
Yeah.
not just for the artists, but for the collectors as well, right? That way they have confirmation that this is the original piece that they're acquiring, and that hence giving it more value.
Yeah, definitely some very cool use cases, and particularly as it pertains to NFTs and artists or any creators, right? So taking a step back and turning this more towards the tax discussion, we talked about a decentralized platform like Yearn Finance, where perhaps maybe you deposit some US dollars, right? You convert that into some token, which then gets deposited onto a decentralized finance platform. That platform then takes your token, does something with it depending on whichever pool you deposit into, and then generates a yield for the depositor. That yield can come back in the form of different types of tokens. It might be one token, it could be 3 different tokens, right? And so tying that back into the tax reporting around that, the concept of even if you determine, okay, this is interest or this should be dividend, right? Even just quantifying that, when you take a step back and try to figure out, okay, I'm earning it in real time. What was the price of these tokens at the point in time that I earned it? Can either Yari or Chris, maybe you can just speak to sort of the complexity that presents from a pure tax reporting perspective.
From a pure tax reporting perspective, the complexity is obtaining the correct information, right? Fair market value and tracking all of these transactions. So, and a lot of exchanges today have their own tracking system, and there are other apps that help you do this. But I think, that's where really the issue is. Being able, some people do thousands of transactions a day. People that do this, I know a few people that now do this for a living. So, that's figuring out fair market value. The IRS is but somewhat lenient as to how you figure this out. And typically what's being published in an exchange on a particular date would be generally good enough. They haven't challenged that yet. But yes, I think that the biggest issue is the ability to obtain timely and correct information for exchanges.
Yeah, and really the exchanges should be providing this information to everyone in a 1099. And I think that's the way it's going. We'll talk about the reporting changes later. But it's so hard for individual taxpayers to keep track of their cost basis and all these various tokens when they bought them. And like Yari said, there are some third-party platforms that you can pay to do this for you, but that comes at a fee that really the exchanges should be bearing, in my personal opinion.
Yep. So speaking of 1099s, I think that leads nicely into the topic of tax reform and some of the reforms that we're seeing directed towards the digital asset space at the moment. I think maybe we can start with some of the discussion around the reforms that recently passed the House. And if anybody was following at home, there was sort of a holdup with respect to the bill getting through the House. It was probably 4 weekends ago, something like that. But there was this big debate around some language that was very directed at the digital asset space. So Yari, would you mind explaining, some of the changes that were proposed and what ultimately ended up in the legislation, and I guess the debate, maybe you could frame the debate around, what the impact of that legislation might be.
Yeah, for sure. As it stands today, it's called the Bipartisan Infrastructure Bill. Includes requirements for brokers to report their customers' cryptocurrency gains to the IRS. But exactly what is a broker that is not well defined. It includes, this bill includes a provision requiring information reporting on the names, addresses, and the gross proceeds of cryptocurrencies by brokers. And lawyers of the cryptocurrency industry initially tried to convince Congress to narrow this provision so that it specifically excluded technology companies and in the crypto industry, of course, and miners, but they were unable to win these changes. At this point, the industry is likely to try to lobby the Treasury Department so that when they issue the regulations, they better define what a broker is. But let's keep in mind that the taxation of cryptocurrency would not change with this at all. This is simply a new tax information requirement, right? But the idea is that this so-called cryptocurrency brokers would provide a similar 1099 tax reporting forms to their customers. And what we really want to accomplish this, the lawyers for this industry, is that they want to make sure that the language as it exists today, which basically says that any person who's responsible for regularly providing any service effectuating transfers of digital assets on behalf of a person is a broker. This is way too broad. It would be definitely detrimental to software developers that would now, and miners that would now have to comply with these requirements, even though they don't have a customer base per se, right? That this is what they do for a living. So it would definitely, if the language is not changed, I think it would, be detrimental to the industry.
Yeah, no, I think that's a great description. And if you step back and think about it, at the top of this discussion, we talked about the fact that, the vast majorities of these transactions are anonymous. And then you compare that to, legislation coming in saying, hey, if you're determined to be a broker, you've got to provide 1099s, which include all this personal data. So depending on how Treasury, I guess, ultimately views this language, they could essentially make it such that, none of these operators in the digital asset space could function in the US because they would simply be unable to comply with the regulations that are being proposed. So it'll be interesting to see how the legislation evolves in this space. I think, just my personal opinion, it feels like everyone's trying to get to a reasonable answer. I think, Chris, you mentioned the fact that, exchanges should be providing this data. And I think that does make sense. I think it becomes more challenging when you say, okay, you got a centralized exchange like Coinbase, which is its own exchange, and there's a corporation behind that exchange. I think it becomes more challenging when you've got a decentralized exchange with no, there's no party that the U.S. government can go after and say, hey, you should be providing 1099s to your users, because the blockchain itself is a decentralized network. And so I think that's where you start to see some of the challenges with respect to compliance, and really why there's been so much consternation around this language. So Mitch, not to put you on the spot, any particular view there from your perspective?
Yeah, I mean, again, speaking from my opinion, not that of the federal government, and I'm certainly not authorized or even know any of plans that would be coming down the pipe anyways, because that's just not what I deal with on a daily basis. But, I think we're more likely to see the use of it regulated as opposed to the blockchain. And so, as opposed to like the underlying technology, right? So, I mean, the CFTC, the Commodities Futures Trading Commission, they classified Bitcoin as a commodity because, like you said, it's a decentralized blockchain that, if you think about it and relate it to like gold, I could go outside and find a piece of gold, like mine for it with a pickaxe and find a piece of gold. And now, the IRS will probably say that's an ascension of wealth. And then I have to, pay taxes on that. But, the same, I think, example could probably be applied to Bitcoin. And so I think we'll see more regulation around the use. So if, to Chris's point, if I'm using an exchange, a big company similar to a bank or whatever the case, or E-Trade or something like that, where I'm exchanging the cryptocurrency, I think the onus will be on that particular company to help the individual, with their tax information. And then I don't think you would see a peer-to-peer tax transaction. It would be a taxable event on your personal side, but I mean, there's no way to kind of regulate it aside from, having an individual report their income. So I think we'll see it more on the company side and the use of it, lending companies, whatever the case is.
Yeah. Thank you.
Yeah, and I'll just add, I mean, I agree with Yari. I think, the legislation looks very broad, but I think Treasury will do a good job to make it narrow and reasonable. I'm cautiously optimistic about that. So I'm not too worried about it. It's also worth mentioning, though, that they also have a definition of digital asset in the legislation as well, which is very broad. Really, anything that touches cryptography is captured. And I know they write this because they can't predict the future technology, and they want to make sure they encompass any future possible tokens. But it covers a lot, not only cryptocurrency, which I think is the main concern. It covers NFTs, arguably. It covers various real estate, digital assets. So it may be more than just what they may have targeted, but who's to say?
Yeah, definitely an area to keep an eye on. Chris, would you mind walking us through a couple of the other provisions? So what Yari just described was in the infrastructure bill. Obviously, for those of you that are following the news, the House is in the process right now of passing or trying to get agreement on a reconciliation bill, and that includes a significant amount of tax reform. Some portion of that tax reform is directed at the crypto space. And so, Chris, would you mind touching upon a couple of the other provisions in that draft legislation that you think might have an impact on the digital asset space?
Sure. So I want to talk about wash sales, and I hope people don't leave the webinar when I start talking about wash sales, but it is important to know as an individual, what is a wash sale? So a wash sale is if you have a built-in loss, it's a way to recognize the loss by you sell the security, you recognize the loss, and then you buy it right back and you're no different economically than where you were before, but now you have this loss that you recognize that you can use for tax purposes. And so many years ago, Congress didn't like this, creating artificial losses for tax purposes. So they enacted wash-sale rules. And the rules themselves say you can't sell a security at a loss and then buy it back within 30 days. Otherwise, you will not be able to take the loss on your tax return. And so that's been the rule for many, many years. The issue, though, is that cryptocurrency, it's pretty clear that it's not a so-called security for tax purposes. It may or may be for securities law purposes, but the case law is pretty clear that it's not for tax purposes. And so, right now, you could do a wash sale with crypto if you wanted. So part of the legislation proposal is to change that to expand the definition of stock or securities to include specified assets, which would include digital representations of value, such as cryptocurrencies. And so this would be effective after December 31st, if enacted. So if you're going to do your wash sales with crypto, do them now before the end of the year.
Bit of tax planning advice for the audience, for those of you that own digital assets.
So does that mean that no more day trading on crypto and riding these huge fluctuations in the value? Because Dogecoin, for example, I think it's up like 30% today or something like that. You think that'll have an effect on day trading? You think it'll stabilize the cryptocurrencies?
So it could. And by the way, the Axie Infinity coin is up 30% today as well. So I don't know what's happening in the market. But it's and I think it should, because right now everything is so volatile. And probably most people are not buying and selling assets for tax purposes. They're probably trying to go to the moon with their crypto, but it's and maybe people like the volatility, and that's why they're in this space. But certainly as things become more regulated, it's going to make it more stable as well.
Great. And any other areas of tax reform that you think will have an impact on the digital asset space?
Yeah, the last thing I'll mention, and this is not for crypto specifically, but there is a proposal to raise the capital gains rate. Currently, right now, it's at the highest 20% plus another 3.8% if you hold for longer than a year. And they're proposing to raise that up to 28.8%. At least that's what the House wants. And so obviously, if you're going to be recognizing a crypto gain that you've held for longer than a year, your tax could potentially be going up on that. What's interesting is that this, if enacted, would apply to any gains realized after September 13th of this year. So no end of year tax planning for this one. If enacted, you're stuck paying the higher rate because they probably recognize that everyone would sell their gains. But starting next year, this top rate's only going to apply if your taxable income exceeds $400,000 or $450,000 if you're a joint taxpayer. So it really is only targeted towards the upper class income people, which may or may not affect you.
Yep. Great. So one of the other trends that we're starting to see is employers offering tokens as compensation to their employees. Chris, would you mind speaking to some of the tax issues that might arise with those type of arrangements?
Sure. And I hope I'm not dominating all the conversation, but so in my practice, I'm mostly on the corporate side. And what we're seeing, interestingly, is historically, especially in technology, a lot of companies would offer stock incentive plans for their employees, in addition to cash salaries. both because it's cheaper to issue stock than it is to pay cash, but also it aligns the employees' incentives with the company. So they have an incentive to help grow the value of the company. And so, we've seen a lot of these stock deferred compensation plans in the past. What we're seeing now are deferred compensation plans involving tokens. And these can either be tokens issued by the company itself, if the company is an issuer, or it can be a token that the company happens to have on its balance sheet for whatever reason. Maybe it just wants to diversify its holdings and hold some crypto. And so we're seeing a lot of this similar deferred compensation plans with stock with tokens, because again, token is a piece of property under the tax code. And if you transfer property to an employee in exchange for services, that can be deferred over a few years under the tax law. So it's really no different than giving an employee a piece of stock. Where it does get kind of interesting is there's certain restrictions on what type of equity awards you can offer. Specifically, you can't offer any options on tokens like you can with stock, because there's a section called 409 Cap A in the tax code, which is a terrible section, which doesn't allow options on property except for stock. So while you can't have stock options, you can have other types of instruments, restricted tokens, restricted token units, and the like, and still get some of the same benefits that you would with stock. So again, I hope I didn't lose anybody else during the webinar.
Something somewhat related that I've seen lately, I've seen a couple of startups. One, it's already well established, but they're starting to sell this product, which is basically employees can exchange their PTO for tokens and invest them and make money on their PTO, whether they use it or not. So I thought that was very interesting. That would come with its own set of issues and taxable income.
Yeah, I think it's, hopefully over the course of this 50 minutes so far, it's become increasingly clear that, it's going to be a challenge for authorities in general to keep up with the pace of development in the space, right? I mean, you see all these different and creative ways of transacting with digital assets, and inevitably it leads to a lag between the creation of these transactions and then the time that authorities are able to react and issue adequate guidance. So it seems like it's going to be a continuing challenge, and I guess we as practitioners will do our best to take reasonable positions with respect to these various transactions. But
Yeah.
definitely an interesting space to operate at the moment. Mitch, you wanted to jump in?
Yeah, Chris, and I guess if you could answer this maybe, or if Yari wants to as well, because I just don't know. So I don't know if we talked about it before, but the IRS issued a guidance on the taxation of forks, and forks in the cryptocurrency, or forks in the blockchain that create a different cryptocurrency or a new version of it, or whatever the case is. Do you think that the IRS would view, or do you think companies would utilize a fork as like a stock option, saying like, we're going to have a fork in a year from now, and it's going to create so anybody that's here at the company on this day, you'll also get this fork currency, which will create an additional incentive. And then how, in your opinion, the IRS would maybe tax that as well? Would it be different from the current guidance on forks, do you think?
I mean, I think it would be taxed at the time they receive the new cryptocurrency when the fork happens. It would be highly unlikely they can put any value on that fork at the time it's awarded, not knowing when it's going to happen. I don't know, Chris, if you have any thoughts about that. But I mean, if we want to back up a little and talk about what forks are, in case people don't know, there are actually two types of forks. You can have a hard fork, which is basically when cryptocurrency splits and creates two or more branches of the existing cryptocurrency, but because the code changed. So this results in like two versions, right? That's what happened with Bitcoin and Bitcoin Cash, or classic Ethereum and ETH now. A soft fork is more like an update to the blockchain, right? It doesn't really create a second coin. So in the eyes of the IRS, a hard fork, the minute you receive a hard fork, that's taxable, right? You have any coin, I mean, whether you wanted it or not, whether you know or not, you receive something that's taxable. So, I mean, I'm trying to think about it from what Mitch just, from the point of your question. I mean, you almost look at it as if you're, I mean, it looks like restricted property almost, right? Because you have to be there for a certain amount of time and probably meet certain requirements to qualify to obtain this fork when and if it happens. Any thoughts, Chris?
Yeah, I would agree. And the nice thing about restricted property is you can usually make an 83B election to get beneficial tax treatment for that. But I like the idea, and I think I'm going to put it in my toolbox, Mitch, for
There
my
you go.
clients. So thank you.
You're welcome. I don't know if this has ever been
this.
brought up before. I was just my wheels are just spinning. I'm like, that, if I can't issue stock options, I could just say, yeah, we're going to do a fork. And if you leave the company and still hold the cryptocurrency, do you still get the fork crypto? I don't know.
And to make sure we don't lose anybody, let's explain why the 83B election is. So when you receive restricted property, you're allowed to make an election to include the value of the property in taxable income on the value had on the date of grant. The idea is that this property is probably going to appreciate, so that any appreciation, depending on the holding period, you could get capital gains tax treatment. Obviously, you would make the election if you expect that the property will appreciate, otherwise it makes no sense. But
yeah, some great thoughts there, and certainly demonstrates I guess the creativity that's possible right now, given sort of the new types of transactions that are out there, and I guess I'll say lack of clarity as it pertains to certain topics. Mitch, any other areas, transactions that you're aware of where we might see, additional guidance released in the future, or where we think it might be useful for authorities to issue additional guidance?
So, with the explosion of NFT popularity, I think you're getting into an area where the regular Joe Schmo investor or collector, I'd probably just give it away, but of NFTs and like a digital piece of art, I think that not very many people are going to recognize the tax implications on that, and I don't think that the IRS has issued any guidance whatsoever on NFTs. But I think what we'll see is, I think because at its core theory, an NFT, a non-fungible token, is that it is unique. And so if I'm buying something that's unique, it could fall into the category of collectibles, which then pushes it into a different realm of investment, as opposed to just like buying and selling cryptocurrencies or whatever. Those are essentially fungible. I could transfer 20 Bitcoins over here, and then they're not necessarily, the individual Bitcoins are not necessarily tracked. It's more the transaction. And if it's unique, then the IRS could argue that it's a collectible, which pushes it into a different tax realm, where if you're a high net wealth individual, you're gonna see a higher tax rate. I think it's 28%, something like that, as opposed to the regular property-based taxation of cryptocurrencies and things like that, where it's just long-term capital gains and short-term capital gains. So I think, when another thing that people aren't gonna immediately recognize is that if I purchase an NFT with cash, there's no taxable transaction that's really happened there. I mean, aside from like sales tax or whatever, but you know, I'll have my basis in that NFT. So if I buy it for $1,000, that's my basis. Whereas a lot of the NFTs are based on the Ethereum network. And so some of them require that you purchase the NFT with Ethereum, meaning that the second you transfer that one Ethereum to the artist or the NFT, I have that taxable event. So if I bought Ethereum, you know, 2 years ago at $1,000 and now it's 3,000, I'm going to have to pay taxes on that $2,000 of realized gain. And then I've got a basis in the NFT. And then whenever I transfer or, you know, transfer ownership of that, I'll have another taxable event. So I think that's one thing that we may see probably sooner rather than later from the IRS, because I think one NFT recently just sold for like 69 million or something like that. So we're talking huge amounts of gain that I would imagine, you know, should be taxed.
Yep. Pretty interesting. I'd be curious to see how, and, you know, somebody's getting $69 million worth of value out of that NFT, but it's, you know, art is in the eye of the beholder, right? As they say.
Yeah.
So I know we've got a couple minutes left, and then I think we want to leave 10 to 15 minutes for Q&A. So did want to touch on the topic of sustainability. You know, I think a lot of one of the criticisms that you've seen levied against the digital asset space, and particularly at Bitcoin, is you know, energy consumption, right? And so I think it was probably 2 or 3 months ago where Bitcoin shot up to around 60,000. And I think a lot of that was on the hype of Elon Musk tweeting various bullish things about, you know, using Bitcoin to buy Teslas and the like. And then at some point, you know, he sort of reversed track, and one of his tweets was about, you know, suspending the use of Bitcoin to buy Teslas because of the amount of energy consumption that Bitcoin mining causes. And then there has since been this great debate about energy consumption and you know, around Bitcoin. So, you know, I guess the question I'll pose to the group is, you know, do we think that the criticism around the amount of energy consumption that some of these blockchains require is valid? And if so, you know, what do you think that the digital asset space and actors in the space can do to combat that criticism?
I mean, well, I mean, the information as reported, as far as, I mean, when it comes to the energy consumption that it takes to produce a Bitcoin, right? I mean, you've heard that it says that, you know, it consumes 13 years of a typical household electricity to mine a single Bitcoin, right? So, I mean, when you see that, you feel like makes perfect sense that the impact is a huge concern. But Bitcoin is not the only cryptocurrency that causes the environmental burn, by the way. It's just the one with the highest profile. We're talking about all cryptocurrencies. I mean, as we've been discussing today, Bitcoin requires computers to solve complex math problems, right? And this is the basic concept that we call proof of work, right? And it's drastically more energy intensive than any other transactions. Some people think that a solution could be the proof of work system, proof of stake system, sorry, because it doesn't consume as much energy. A proof of stake can achieve with low power consumption the same outcome, because it simply requires miners to front end a small amount of cryptocurrency. It's sort of like a lottery, and then for the chance to verify the transaction. So you don't have, you know, millions of people trying to verify the transaction at the same time trying to earn one cryptocurrency. You have a person at a time, let's say, working for this proof of stake to earn this cryptocurrency. So that definitely would remove that, you know, component of the environmental impact that we think cryptocurrency has right now.
Yep, I think that's a great point. And for those of you that follow Ethereum, you may be familiar with the fact that, you know, they're working towards Ethereum 2.0. And I think one of the big changes is going to be this this conversion to a proof of stake method to arrive at consensus versus proof of work. So, I think, as those consensus mechanisms are more greatly adopted, I think, perhaps that'll put a dent in some of the criticism around the amount of energy consumption in the space. It was interesting today, again, for those of you following the news, you might have seen that recently the country of El Salvador, adopted Bitcoin as legal tender. And within the last 24 hours, the president of El Salvador is tweeting that they just mined their first Bitcoin using energy from a volcano in El Salvador. So, getting to the question around sustainability, even if, all these blockchains don't ultimately convert towards proof of stake, namely Bitcoin, it feels like miners are going to attempt to come up with ways to utilize alternative energies to execute on their mining activities. So just that.
Yeah, and I think it's worth adding. You're absolutely right, Eric. I mean, Ethereum's moving to proof of stake. A lot of other tokens are already on proof of stake, Cardano, Polkadot. So that's definitely the trend. And Bitcoin, you got to realize there's only 21 million possible Bitcoins. Like, that's the max. So at some point, we're going to run out of Bitcoin, and there's not going to be any more mining of Bitcoin. So it's probably a limited time problem. And I think over time, it'll all be a lot more energy efficient.
Yep, that's definitely a great point. So I think we've got time for one more question, and that'll leave us with about 10 minutes for Q&A. Hopefully we get some participation from the audience. But I just wanted to kind of leave the panel with, what I think is sort of a fun question. So maybe I'll just ask the three of you to comment, what excites you the most about, the digital asset space looking forward? I know this is, not to put you guys on the spot, but, or maybe if it doesn't excite you, maybe what concerns you the most about the digital asset space going forward? I'll give you, jump in as you see fit, but I'll give you time to think about it.
I can start if you guys want. I like that it has a blockchain technology and the ability to have a public ledger that everybody can participate and everybody can view. I think it's great because things can happen out in the open and we don't have to be secret about it. We know exactly like where things went. We may not know who did the transaction, but we can at least trace where that went. And I think as we see blockchain, I think the individual coins maybe won't stay around, but the underlying technology is there. And one thing that I've been trying to gain more traction on throughout my community and sort of like the legal community is to get people thinking about alternative ways to utilize blockchain. And one of which I think is particularly interesting is called microbonds, where traditionally municipal bonds are done by these huge banks and they charge a ton of money to, allow the city of Miami to put forth a municipal bond. But with microbonds, using blockchain technology, you could in theory allow everyday citizens to just buy $5 here, buy on a blockchain public ledger situation, and then they're investing in their own community. The interest is being paid based on however much you're putting forth into this micro bond, whatever the case is, and you kind of cut out the middleman for lack of a better word. But I think that is probably pretty interesting, most interesting to me.
I mean, I would agree with you, and I think definitely blockchain technology is probably the future of every transaction and how we, relate to each other, even from the gaming industry to, things at home. I think it's a future. My only concern is that, governments and regulatory authorities just can't keep up with the pace of advancement, really. We didn't talk much about the ransomware attacks, but that's an issue, right? The technology lends itself for criminal activity in a lot of ways. and governments have been slow to keep up with it. That would be my take on it, but it's definitely the future.
Yeah, and for me, I'm a big fan of this concept of the metaverse. Have you guys heard of this? So this is the idea that we will all in the future live in this virtual reality world together. And I think it's coming personally. And I sort of envision there's a world where we all live in this virtual universe and we're using cryptocurrencies to do transactions in this virtual world. And we're looking around, you can see people's NFTs in the virtual world as well, and hear their NFT music. And so, that's probably 20, 50 years away. But I think there's possibility there.
Yep. Thank you each for your thoughts there. Yeah, I like the concept of the metaverse, Chris, and it's interesting, just thinking about that concept. And I joke around with my friends as it comes to the gaming industry. For anybody that's been following the blockchain gaming trend, and I know somebody mentioned Axie Infinity earlier on the call today, or on the discussion today, and you think about the fact that somebody, let's say in the Philippines, can now earn a living simply by playing a video game, right? And they're accomplishing various things in the video game, which create NFTs that they can then go sell in an open marketplace. And it's really interesting, thinking about that concept and the metaverse, like you mentioned, Chris. And I joke with my friends and say, at some point, all of us are just going to be sitting at home playing video games while, blockchain technologies are doing all the work that all of us are currently doing. Feels like it might be, a potential future, like you said, 20 to 50 years from now. So it'll be certainly interesting to follow. And, I would encourage those of you that are in the audience that, perhaps haven't paid much attention to blockchain and cryptocurrencies, if I'm a proponent of the space. And so, if you do a little bit of digging, there's a lot of interesting topics to uncover here. So with that, I'll open it up to Q&A. I think we've got about 6 minutes left. So if anybody in the audience has any questions that any of our panelists can answer.
Yes, actually, this one is a question for all the panelists. Do you think cryptocurrency will ever be mainstream enough to replace all of our paper currency?
Yeah, maybe I'll go with that one. So the U.S. government has been looking at a possible digital dollar. In June, the Federal Reserve said they're looking at this very closely. Some have predicted that at least a fourth of the G20 will have a digital currency by 2024. So there's a lot of advantages there. Again, you cut out the banks, so there's no fees. Payment can be done instantly and permanently without fees involved. A lot less volatility, as we talked about, and then just make more global accessibility. So anybody that's had to do cross-border payments to other countries know it's a nightmare, and it takes a long time and it costs money, and this would be instantaneous and less costly. And we've seen they're already getting rid of the penny. That's going to stop being printed in 2023, I think, because it costs more to make a penny than the penny's actually worth. And so paper money is just kind of silly to me at this point. It's a waste of trees and resources. And we can do all this digitally, I think, is just my opinion.
Yeah, I think I don't know if we'll see, because I think still at this point cash is king. But I think from a money laundering perspective, it's probably really a good thing to think about, because if you make each dollar, digital dollar, let's say, have its own identification number that is tracked on a blockchain, then it makes it more difficult to launder money. So I think, that's probably something that's, in consideration when they're looking at it. Again, I have zero idea what is being talked about at any level in the government. But, That's where I see it going, I guess, if they decide to do it.
And I completely agree with both of you, and it makes perfect sense that that'll be the future. I mean, some countries like El Salvador, for example, there'll be other countries that, I mean, I know across Europe, many countries are considering this very seriously. So I think it's closer than we think it is. I mean, I think the US will take longer to adopt it, but I think it's definitely going to happen, or something similar. Not the way maybe we think about it, but within the technology itself, for sure.
Yeah, I could see China doing something similar, you know, making it so that there's no more cash and everybody has to use, you know, some type of digital representation of cash or something.
Yeah, I guess the only downside is the federal government will know every transaction you do, right? There'll be a record, and do you want the government knowing what you're spending all your money on? Maybe not.
Yeah, there's definitely some interesting privacy issues, right? And I think the debate in the U.S., you know, as this technology evolves, will be, you know, how much privacy are we willing to give up in exchange for convenience and efficiency, right? So,
well, if history can tell us anything, we are willing to give a lot of our privacy for convenience. We have already.
Yeah, I get 10% off at like Bloomingdale's if I give them all my information. So
perfect. Send me all the spam emails you want, right?
Right.
Any other questions from the audience?
Just one really good one. I recently purchased an NFT of the National Championship ring. After last night's game, is it still worth what I paid?
Yes.
Yeah, I think that's a loaded question.
Yeah. It's values in the eye of the beholder, right? So, you know, like I got my Taxel. I'm from University of Miami, so I'm a huge Canes fan, and I would probably purchase it. But you know, who knows?
Yeah.
It's obviously about demand. If you get enough people to invest in it, just keep talking about it and it will.
Yeah, listen, hopefully the, you know, as those years become more distant from winning the national championship, hopefully the fan base values them even more going forward. So maybe that's a positive way to finish that answer. So, okay, well, I think we're just about out of time. So really want to thank
we do have one extra question.
Oh, okay, sorry about that.
This is regarding mining. I'm not sure if you covered this, but apart from treating the income as ordinary and the multiple incidences of tax, what about rig costs? Are those deductible?
I didn't get that. What about what costs?
Rent?
The cost,
rent.
Of the equipment, rigs, the rig, and running the operating costs, basically.
Yeah, they are deductible. I mean, would typically miners do this as sort of like a self-employed activity, right? So you would report this on your Schedule C, and yes, obviously your taxable in the income, but also any expenses incurred in obtaining that income are deductible.
Yeah. And I would expect that to include, of course, depreciation on any, you know,
equipment. Utilities, obviously.
Sure.
Yeah, and I think again, to just reiterate the point that we made earlier with mining, is that you're going to have, I think you're probably going to have two taxable events, you know, when you receive the transaction fee or, you know, the reward for doing the mining. And then whenever you transfer it, so if you immediately transfer it, you're going to have another taxable event. You know, so it just depends on if it fluctuates that much in price, whatever the case is.
Fantastic. Any other questions?
That takes care of the questions.
Okay, well, great. Well, again, thank you everybody for participating today. I think this was a great conversation, and look forward to seeing what develops in the near future here with respect to digital assets. So thanks everybody, and thanks for the opportunity.
Thank you. Have a good one.
You know.
Take care. Bye-bye.